A lot of my friends think the stock market is risky and avoid it, instead holding on to cash beyond what they need to fund their emergency budget. So in this video, we'll cover some arguments which should form part of your foundation for investing in the equity markets and make it clear that investing is not gambling. So let's get into the mood for this. To start with, I want to focus on some of the teachings of two gurus: Warren Buffett, the greatest investor of our time, and Tony Robbins, the greatest personal development coach of our time. And then also, being a scientist, I want to take a look at what the computers think and what the science is behind it too. So first off the bat, investing in the stock market is not gambling. Investing is not gambling, full stop, basically. There is investment risk, let's call it the coefficient of success, because, you know, geeky and all of that. But to get the coefficient as close to 1, i.e. not lose money, in fact, investing in the stock market, the most successful strategies have been the simplest ones. Yes, I have said it. With all the films, the newspapers, the hype, the books, the platforms, the YouTube courses out there, they all tried to beat the markets and they failed. So there is one caveat generally to get out there first. That is, investing in the market should be done over a long period of time. Your investment horizon should be out there in the distance. The longer the better. So over a 10-year period, the most effective way to invest is also the safest, simplest and cheapest. So what about the Warren Buffett test? So let's start with Mr. Buffett himself. So in 2008, Warren Buffett challenged the hedge fund industry, arguably the collection of greatest traders on the planet, to beat the market over a 10-year period. Buffett claimed that post fees and expenses, index funds outperform a hand-picked portfolio over a decade time period. We have been over index funds in prior videos. So for completeness, an index fund is a fund that is constructed to match the market returns themselves. So if you buy a FTSE 100 fund, you will receive the return of the index. In the cases of the FTSE 100 index fund, you will own a little bit of each of the FTSE 100 to guarantee the return of the index less the fees. The fees themselves are cheap, very cheap compared to mutual returns, as no human curation is required, and there is also no promise of any alpha, and alpha being returns greater than the market by picking stocks better than the market. The other main advantage of an index fund is diversification. So in our example, with one purchase in a fund, you own the entire FTSE 100, which is roughly 100 stocks that make up the market. The actual number of shares is 101. So let's sum it up. Index funds are cheap, track the market, and are also well diversified. It doesn't have to be the FTSE 100, it can be the S&P, or it could even be the world, a fund that owns a number of indices across the globe. You own the world, if that was always your hopes and dreams. But the question is, was Buffett right? Well, yes, he was actually. The simple index funds beat all expert hand-picked funds over a decade. So there's no need to agonize over picking individual funds. Pick diversified index funds and be happy in the knowledge that over a sustained period of time, you've done well. The next question is, what did Tony Robbins find? So Tony Robbins, if you don't know, is one of the most well-known motivational speakers and coaches on the planet. He has written a number of best-selling books, and one of those is called Money, Master the Game. A monster of a book, I'm not gonna lie. It's over 650 pages or something ridiculous like that. He interviews some of the greatest minds in finance, people that, unless you're into finance, you would not really hear about, to be honest. The quiet billionaires like Ray Dalio, who has built the most successful hedge fund on the planet. So what is the single most important result and blueprint from the book then? The first lesson is 96% of mutual funds fail to beat the index. And for us mere mortals, the chance of picking a market beating index might as well be zero, right? Secondly, the most critical element is diversify. Diversify across single and multiple asset classes to build a portfolio that can weather booms and busts and consistently grow your assets over a long term. Now, I can really talk about this topic for hours, so leave me a comment down below on which areas you'd like me to explore a little bit more if you're interested. But for the moment, let's know that provided you diversify and try not to beat the market, it's investing and it's not gambling. Just forget beating the market for long-term capital growth, and apologies to all you speculators out there. The third thing I want to talk about is, surely the computers and algo programs can beat the market by now. This is an interesting point, and actually I got quite passionate about this when I read the expose book on algorithmic traders in a book called Flash Boys. I read it quite a while ago. However, true artificial intelligent funds like the Nordic fund FIM, I think that's what it is, have constantly failed to beat the market. And the rationale is that yes, artificial intelligence and machine learning can make more rigid decisions on past events and indicators. The reality is they cannot really predict the future. And actually being human in the market is where the alpha is, if there is one. Alpha being that percentage at which you beat the market. And that is a fascinating topic. And being in technology, I am fascinated about that. Having said that, and for the purposes of this video, no, machines have not beaten the markets either. So let's talk about the rules. Rule number one, let's get back to that golden rule, diversifying. How do we achieve it? Diversification is the most crucial way to invest for the long term, and it outperforms hands-on investing in the stock market. The simple rationale for this is that the world and our systems are very complex. A tweet from the charismatic Iron Man CEO or excitable president can send the market into a frenzy. We've seen that historically. Business scandals can erode trust in a company or a sector, and booms and busts can happen from the most unlikeliest places. Virus, anyone? Companies that were once at the top of the game, remember IBM in the 80s and Netscape or even Nokia, can fall into irrelevance. If they don't innovate, they will die. Remember that Schumpeter theory. Despite all of this, we investors, generation after generation, opt out of diversifying. It's in our human nature to become complacent or deluded or both, that the world that we do live in will be the same world tomorrow. When in history of human existence has that even been true? Diversifying generally protects your money. You spread your investments across industries and nations, making your portfolio more robust, but also trending in line with the world. So how do we diversify? Well, the easiest and simplest way to allocate it should probably be allocate. So as I was saying, the most easiest and simplest way to allocate the equity component of your portfolio is to low cost index funds. I say equity components because your investments should include the full spectrum of assets as you get older. The wider the range of assets, the more balanced and weatherproof your portfolio becomes. Now, index funds have astonishingly low fees, and with one single purchase, you own hundreds of thousands of underlying companies. I invest pretty much all of my equity investments into index funds. It's cheap, I hold it for a very long term, and so I can use the tax benefits and SIPs and LICs, and it's simple and requires very little thought as well. Just get it done, as I say. So there are plenty of providers here in the UK and US that offer it. I use Vanguard. You can choose a provider that is well known, large, and available quite easily to you. A very important closing point I do want to make is don't try and time the market, guys, or fret about when the perfect time is. Those that do try to time the market very often pretty much fail most of the time. No one's got a crystal ball. Instead, make investing part of your monthly ritual, create your budget, allocate money to investing, and get it invested. This concept I have to hammer home is called dollar or pound cost averaging, which is basically saying that spread your investments over time, and that irons out that volatility, which is a fancy way of saying peaks and troughs, really. Now, I know that this is not the sexiest way to invest. It's a little bit boring, but investing is not about being sexy, guys. Just one of those things. It is about being consistent. Here I have a few more videos on diversification, which covers that good old topic of dollar cost averaging, pound cost averaging, how to get started with investing, and a few other videos that flesh out some of the ideas on this one. Enjoy, guys!